All right, hello students. Here we are, Module 8. We're going to talk about statement of cash flows first. And we've gone over the income statement, the change in OE, balance sheet, and now we're going to introduce and kind of get a firm understanding of the statement of cash flows. And so in the textbook, it talks a little bit about the statement of cash flows being adopted in 1987 before they prepared a statement of changes in financial position. However, there wasn't enough information on there. So what FASB did was they created this statement called Statement of Cash Flows, which would be more useful. Right now, if I were to ask you, how much money do you have in your checking account, you probably could tell me that pretty quickly. And so the statement of cash, what it shows is how did we start with $10 and end up with $15? What caused the change in $5? So the income statement kind of shows you your income for the year, but if I just gave you a beginning and ending cash number, you'd have no clue on what caused that to change. So what you need to understand about statement of cash flows is that it's not income. And a lot of beginning accounting and finance students get confused with cash and they think it's income. It is a totally separate thing. And the reason being is that it's broken down into three different parts: operating, investing, and financing activities. And I'll get to more of that in a second. All right, so what is the purpose of the statement of cash flows? We want to see if they could generate positive future net cash flows. Operating activities must provide sufficient net cash flow to support the firm's operations. So we want to make sure in the upcoming year that from our operating standpoint, we're moving in the right direction. Cash is growing through operations, it's not going down. 2, assess the entity's ability to meet its obligations to pay dividends and its need for external financing. What better time when we look at dividends right now when we look at oil companies? Right now, we saw the price of oil was at negative $36. Well, what does that mean? It means that the cost for a lot of oil companies to pull the oil out of the ground versus what they're getting was causing this negative amount. And so since they have this negative amount pulling oil, they might not be able to pay their dividends because they might not have the income to pay a cash dividend. So some oil companies have assured the market that they will continue to pay their cash dividends. Others said they might actually cut it. But when we look at the statement of cash flows, it gives us a clear source of where they're using their cash and can they pay their dividends. 3, assess the reasons for difference between income and associate cash receipts and payments. So if I collect $1 million for you and I sell you something, I'm going to have a receivable and I'm going to have my sales, right? What happens if I don't collect the $1 million from you? My income statement is going to report that $1 million initially, but cash has not been touched there. So what we want to do is we want to make sure we understand the difference between income and cash from operations. And so the statement of cash flows clearly shows that under the operating piece of the statement of cash flows. 4, assess both cash and non-cash aspects of the entity's investing and financing transactions. So firms are going to be making big investments, how they finance their business, and it really breaks down where that cash is going and coming. It's very clear to the user of the financial statement. All right, so the next part of the chapter then, it kind of breaks down the difference in the different sections of the statement of cash flows. So it's broken down into 3 things: operating, investing, and financing. So if we look at this, my first couple of years of teaching accounting, we kind of walked through this chart. And students always kind of struggled. It was a memorization piece. And really one day I sat down with Dr. Dan Dinas and he explained pretty quickly, oh yeah, if you just kind of break down the accounting equation, you don't have to really memorize this. And I'll get to that in a second. But if we look, our operating activities is our day-to-day. Investing is what's going on with our long-term assets. Financing, are we using equity or debt financing? We just kind of went over that. So you could kind of sit there and kind of read through this, pause the video and look at this. But where I'm going to kind of take you in a second is a much simpler way to identifying the different parts. So here's an example of the statement of cash flows. And so the first section is operations. And so you could see cash received from customers, $100,000. Cash received from renters, $750,000. And then cash paid for all different types of things. And one thing you want to make sure, don't forget that income taxes and interest paid by the business is going to be an operating activity. So then you have a net amount. So from operations, cash went up by $24,000 because of operations. Investing, if you look on investing went down. It looks like they bought a building, and so that big amount caused net cash flows from investing to go down. So their operations are doing well. They made a big investment, and so cash went down because of an investment they made. And then the last part is the financing piece of where they're getting money through debt and equity. And so here they had a negative $3,000 outflow from operating, and their cash went down by $7,800. So there's the beginning cash and there's the ending cash. So that's $7,800. So what caused it to go down by $7,800? Well, they bought a building, right? And they repurchased their stock. So those are the two big pieces that caused their cash to go down. Those are both decisions that the firm made. The firm bought that building because it's going to help them generate future revenues, and maybe they decided to buy back their own stock because maybe they felt their stock was undervalued, or they wanted to decrease ownership. All right, so that is kind of, in a nutshell, the statement of cash flows, operating, investing, financing activities. And before we kind of get in there and start creating it, we're really only going to create the operating piece. But what I do want you to do is I want you to identify if it's an operating, financing, or investing activity. And this is what Dr. Dynas kind of shared with me. And this is kind of the go-to. All right, so if you think of the accounting equation, we have assets equal liabilities and equity. And what we're going to do right now, and this is going to help you identifying if it's an operating, investing, or financing activity of the business, is we're going to break down the accounting equation. So we're going to pull out cash separately, and then we have current assets and long-term assets. So assets, we broke down into cash, current assets, and long-term assets. Liabilities, we broke it down into current liabilities and long-term liabilities, and then we have equity. So here we go. Here are our accounts. This is all review right here. Here are all the different accounts that go with each of those. So if we're dealing with one of these areas in particular, and it's dealing with cash, we're going to be able to identify is it operating, investing, and financing. Well, how do we do that? Well, we're going to kind of move over the current liability or the other current assets, and the long-term assets we're going to take from the left side of the equation. We're going to now dump them on the right side of the equation. Okay, and there's the definitions again for each one. And now we're going to kind of clump them together. So anything dealing with current liabilities and current assets is considered an operating activity. If it's a long-term liability or owner's equity, anything dealing with long-term liabilities and owner's equity, it's considered a financing activity. And that leaves us with long-term assets. And when you think about it, what do businesses invest in? They invest in long-term assets. So those are your long-term assets, are your investing activities. Okay? So now that we take that, we could go back and try to memorize that chart, and that's kind of hard to do. But really, when you think about anything dealing with current assets, current liability, that's operating activity. Anything dealing with long-term liabilities and equity, we just studied that in Module 7, debt and equity financing, those are financing activities. And what does a firm invest in? They invest in long-term assets. Okay? So if you really just kind of stop right there and really let the last 30 seconds sink in, it's by far the easiest way to identify if something is an operating or investing or financing activity. Because what happens now during the year, we keep track of all of our operating, investing, and financing activities, and later in a later lesson, I'm going to show you how to create the operating section. And really what the statement of cash flows is doing, it's an articulation between the income statement and balance sheet. The two financial statements are talking to one another to create the statement of cash flows. That's why the order of financial statements goes income statement first, change in OE, balance sheet. Once you have those three, then you create your statement of cash flows. All right, so I'm going to go through a problem here with you, and I want you to kind of keep this in the back of your mind and we're going to walk you through some sample problems here on how to calculate this. So here is a problem that you have to identify as an operating, investing, financing, or a non-cash event. Now, what is important to understand is that if cash is not involved, it does not go on the statement of cash flow. So, for example, if I buy supplies on account, I debit supplies and I credit accounts payable. There's no cash involved there, correct? Now, when I pay off my supplier, I pay off the liability. So I debit payable and I credit cash. That transaction would appear on the statement of cash flows. But when I buy the supplies on account, that does not go on the statement of cash flows. All right. So first one here, we're going to identify. We're borrowing $50,000 cash on a long-term note payable. And so the key word there is long-term note payable. So if I go back into the PowerPoint that I had here, so since it's a long-term liability, it is a financing activity. So I'm paying off the long-term liability. And so the first one here, this first one here is going to be a financing activity. So we're financing our business through using a long-term liability. All right, second one, we made a sale for $2,500 on open account. So when you go to look at this, you have to ask yourself, is cash involved? So this one, we're selling something. This is kind of like the example I just talked about. This is a non-cash event, and so it's not going to appear on the statement of cash flows, this transaction. All right, because the journal entry there is accounts receivable and sales. I might have said payable earlier. It's accounts receivable and sales. C, reclassified as a short-term liability, the long-term notes payable, $30,000 now due within 1 year. All right, I want you to stop here and really think about what you learned in Module 7. Remember in Module 7, at the end of our roadmap, we made our journal entries and then we made our financial statement. When we went to make our financial statement, we always asked ourselves, what portion of the note is going to be paid in the upcoming year? And then the question was, what is going to be paid beyond the current year? And that's what differentiated between some of the liability being current and some of it being long-term. So here with C, we're reclassifying some of that short-term liability from the long-term portion of the note. So what we're doing here is we're just sliding it on the balance sheet. There's no cash. It's not saying we're paying or doing any of that stuff. We're just reclassifying it from long to short. So that is a non-cash event for C. But hopefully, by now in your accounting careers, you read C, you kind of knew what that meant. If I showed you that on month 2 of the class, you still wouldn't have a clue what C meant. At this point, the good news is hopefully you could read C and kind of understand what that is describing. Okay, D, we're purchasing a building for $120,000 with a $20,000 cash, so cash is involved here, down payment, and signing a long-term note payable for the balance. So we're acquiring a long-term asset with our cash. All right, so if we go back to the PowerPoint, remember the long-term asset? That is an investing activity. So if we look at that one, D is an investing activity. E, we paid the maturity value of $1,050 on a short-term note payable with a face value of $1,000. All right, so what's going on here is we're paying off a current liability. Remember, if we're dealing with a current liability, right, and there's interest involved in there, remember, interest and taxes is also operating. So E is operating. All right, we're paying off a current liability. It is an operating piece. And then in there also, we also have some interest. Remember, interest and taxes paid is done through operating activities. All right, moving on. The next one we have now is we wrote off $500 in uncollectible accounts receivable. In this Module 6, remember Module 6, uncollectible accounts, we're writing off. So we're writing off uncollectible accounts. And so at that point, we're taking out the receivable. There's no cash involved in that entry. So that goes back to your journaling knowledge. So F would be non-cash. G, we paid the liability for accrued wages payable as well as the current period's wages. So we're paying off current liability. It's current. Remember, current is operating, so G is operating. H, paid $2,000 on accounts payable. Once again, that's a current liability, so H is also operating. The next one is you're selling marketable securities that cost $12,000 for $12,750. So that is an investing activity. So if you think about your balance sheet, you have your current assets, your long-term assets, and then we had short-term investments was its own little category. And so your short-term investments that a company makes, those are considered kind of in the same step as a long-term asset. So I would be an investing activity. Then the last one here, J, issued 200 shares of $5 par value stock in payment for equipment having a fair market value of $17,400. You're giving a company your stock for an asset. There's no cash involved for J, so J would be a non-cash event. So that's kind of walking you through how you do this. And what I want you to do after kind of going through this is I'm going to give you a problem. I just want you to kind of classify them and just write them down in your notes. And then I'll go over them next class. And then we're going to start with making the operating section of the statement of cash flows. And this is where you're going to want to spend some time. You will be doing this in your Accounting 1 classroom. I strongly recommend you stick with me this week and really kind of go through statement of cash flows, because really, out of all honesty, out of all the financial statements, it really is, in my opinion, probably the most important one, because you want to see where your cash is going for your business. And the statement tells you what's going on with the three different parts. Okay, guys, thanks a lot.